Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax reform to the OECD's latest developments. I'm Doug McConey, PwC's U.S. International Tax Services leader. You can find me on Twitter at XBorderTax. On this week's episode of Cross-Border Tax Talks, we're back in the DC studio where I'm excited to have back Rebecca Lee, an international tax partner in our Washington National Tax Services practice who specializes in cross-border financial transactions. Rebecca, welcome back.
Hey, Doug. Thanks for having me.
So when we put this on the schedule several weeks ago, I am very interested in this particular topic, which is cryptocurrency. I have a lot to learn in this particular area. Before we dive into some of the tax implications that our clients, practitioners, taxpayers need to be thinking about, let's start with what in the heck is cryptocurrency? And I'm guessing we're going to need to start talking about what is blockchain, what are distributed ledgers, but want to just spend a little bit of time setting the table before we dive into some of the tax implications.
Absolutely. And this is where we start with all of our clients, because the basics are you can't do the tax work without understanding what the technology is and what is it that you're proposing to do. And cryptocurrency, or other phrases you might hear, are virtual currency, digital assets. They're not all one thing, but they all have one common backbone, which is blockchain. So the idea is fundamentally you have technology that allows folks who are geographically far apart to interact with each other in an environment where instead of having a centralized ledger, you have a decentralized ledger. I've been working in this area since like 2014, and it's taken me a long time to come up with a halfway decent analogy. I'm going to try one out on you.
All right.
So imagine I want to sell you my car. I could go to the DMV. I have my title recorded. I can take the title down. I can transfer it to you. You can fill out a form. You can transfer it back to the DMV. DMV will record the transfer. That's a centralized ledger. The DMV is the centralized ledger. Imagine you and I were standing in a room full of people. And I said, hey, Doug, you want to buy my car? And you said, yeah. And I said, okay. And I look around to the folks in the room. I'm like, y'all saw that, right? Doug's going to buy my car. And they say, yes. And the transfer is effectuated. And that's it. That's a decentralized ledger. Now, if you picture that in a digital environment, the way that sort of crowd of people saying yes is sort of occurring is via complex algorithms that folks are running. So complex math, cryptography, which is what gives us cryptocurrency. Mm-hmm. And the earliest base case that you have of that is Bitcoin, which everybody knows now. Everyone's up to speed. I think my dad thinks he's a Bitcoin trader. Yeah. Shout out to Vinny. Hey there. So Bitcoin was the earliest use case. And the idea was you could get folks to use their computing space, their server space, to run these advanced calculations. And in exchange, you would give them something of value. And all Bitcoin is fundamentally is it's the equivalent of a location on the internet that we all agree has value. So if you take all those concepts and you step back, you're like, how is this a thing that the average investor now can go and trade and buy and invest in? But the base case scenario was the idea of how do we use basically unused server space to be able to run calculations and to, in exchange for using that, we'll give them value. So that was 2009. Fast forward to today. And
maybe before we fast forward today, just because I want to unpack I love the analogy of at the DMV of the car. So your point with respect to if there's a whole room full of people and you decide that you're going to buy this car, that instead of necessarily just having this one contract that you would have with the buyer and the seller, it's this entire group of people that helps effectively memorialize or substantiate that you actually have a deal. And so by having this distributed ledger across all these different servers, all these different computers, it creates this unique thing, right, which is that currency. And because everybody is there, that's what gives it value, or at least it helps substantiate that it has value.
But that's exactly it. If you think about the value of a centralized ledger, you have a single point of truth. For a lot of our clients, they think about their financial reporting systems as that single source or that golden source of truth. The idea is that the blockchain itself is self-validating. And we refer to blockchain like it's one thing. Every ecosystem is different. Everyone who designs their own set of code has their own version of blockchain. But the idea, sort of, we do hallmarks, they are sort of, if you will, distributed in nature. They require some kind of proof or validation that the transaction or the transfer or whatever is the subject of the technology actually occurred. And past that, you have limitless variations. And I'll sort of call out something because it'll end up being relevant as we talk about where today's landscape is. Cryptocurrency 1.0 was all about proof of consensus. It's my room full of people who all say, yeah, that happened. In today's environment, there's really been a move away from proof of consensus to either proof of work. I'm putting my server to work. I'm putting my computing power to work. Or there's proof of basically stake, which is where today's market is for a lot of things, which is I'm putting either something of value like money or virtual currency or similar to work. So I'm showing you that I'm contributing or I'm participating in this community by virtue of putting something of value to work, or I'm doing the version of putting my computing power to work by staking the network, which is, and I call this all out because when we start getting into tax, which we will at some point, all of these different things that you might be doing matter in terms of where or which jurisdictions have the ability to tax your conduct, what it actually is. And good thing that we're not talking about the cloud computing regs, because there's a really interesting interaction here of if this environment is all kind of supported and interacting in sort of a cloud environment, because it's certainly not sort of hardware based.
Right.
You sort of have this overlap of I've got a bunch of cool financial transaction stuff with principles and things we talk about for characterization. And now we have a separate set of regulations that tell me the who and what of how you deal with technology that's in the cloud. And there's a pretty good Venn diagram overlap of sort of how these principles work.
Sure. So are we ready to dive into some of the tax? I think, one of the challenges, I think there's a lot out there, particularly with respect to trading and trading cryptocurrency. And I think what I'd really like to focus on is less kind of those individual tax implications and more sort of at the enterprise, at the corporate level, as we think about transformation of our general payment system and how we interact now with actual physical currencies. And, when I go to a new country and I'm going over to Europe and I've got to get my euros and, as we think about, well, if this could be this ubiquitous currency that is cross-border, that customers can use it, clients can use it. And then we also start thinking about settling intercompany transactions. Let's kind of dive a little bit. I mean, where do you even begin? And where are we where is the technology from that perspective? And how close are we to me having a virtual wallet full of cryptocurrency to settle transactions as I travel around?
Well, we're there today if you so choose to do it. But the way this comes up and especially for most tax folks who are working in this area, it comes up because the business is trying to solve a problem. So you either I have customers globally who want to be able to purchase anywhere, and I want them to be able to purchase easily and seamlessly, or I have intercompany transactions that I'm looking to settle. And like the single biggest problem that folks are doing from an intercompany standpoint is settlement time. So regular way trade through a SWIFT network takes up to 3 days to settle. And that's assuming you've got close of day settlement.
And what kind of network?
SWIFT. It's one of the financial systems that uses to sort of transfer cross-border wire payments.
Okay.
Depending on the specific blockchain ecosystem that you build, transactions can settle in 3 minutes. So if you're a treasurer and you're saying, I take foreign currency risk for multiple days in the current system, I could reduce that to minutes. I have execution and transfer risk that I can reduce substantially. And certainly, I think apropos of maybe some of the earlier podcasts that you've done around sort of China and what they're doing from a currency regulation standpoint, what's going on in Argentina, Venezuela as good use cases, the ability to be able to transfer assets quickly, not just to reduce variability, but also just straight up to be able to get cash out of markets in which you don't want to be in the currency to begin with, and to allow customers to transact with you in an environment that might be outside their local currency environment are all really powerful drivers. So a lot of times the business will come in, or various pieces of the business, and say, we want to be able to have a platform where retail customers can be able to buy and sell with us using some kind of virtual currency. Or we want to sort of take what we have now from a GL standpoint and from an intercompany payment settlement standpoint, and we want to make that virtual in nature. And let
me just make sure that everybody understands what that risk is, because even in your 3-day example, right? If a treasurer, if a company is trying to do one of these big wire transfers and bring money out of maybe one of these troubled jurisdictions, then depending on how long it takes, then there obviously can be currency volatility from when that transaction is set up and then ultimately when it's settled. Now, certainly there are things that companies can do to go out and hedge that risk and try to manage that risk, but that obviously has cost. And so to the extent that you can do it within seconds or minutes as opposed to days, that then takes that risk off the table that you would have that potential massive currency fluctuation, or anytime, whether it's massive or not, you can minimize the currency fluctuation during that time period.
And not to completely geek out on the kind of geopolitical aspects of this, but if you take Africa as an example, there's a significant portion of the population that is unbanked or minimally banked. So like when I was in Addis a couple of years ago, everyone paid by phone and they had sort of just app accounts where they kept their money. They didn't go through kind of traditional banking institutions. So if you're an organization that's trying to tap customer markets that you don't get to today, your ability to transact with multiple folks in a single medium for payment to facilitate cross-border payments, and especially to reach the folks who are unbanked, is a huge potential when you think about growth that you're not capturing in the market today. So if you think of all of those being the business problems you're trying to solve externally, you kind of look internal and you say, wow, anyone who's done an SAP treasury build, which I think there's some folks who might be listening who've experienced this directly or indirectly, the mechanics of getting just plain vanilla tracking of your transactions, measuring your transactions is substantial. It's an investment. If you could do that in a technology that automatically tracks all of that, synthesizes it, gives you transparency, gives the counterparty you're paying transparency, that's also really powerful. So a lot of times this bubbles up for our tax folks because we're trying to take 2 or 3 really great things the business wants to do and say, well, crap, what do I do with them? What is this? And how do I account for it?
In a pure cryptocurrency environment, so let's assume if we could get out of the physical currencies in a pure cryptocurrency, is there still that volatility risk between different cryptocurrencies that will then need to be hedged or managed depending on what type of cryptocurrency or what system you use?
Absolutely. So this is sort of, it's the equivalent of, it's going back to when tulips were a medium for payment, or go earlier where shells were a medium for payment. It is a fundamental reexamination of what is value and what is money. So all of these assets are just going to change in value. So if you decide tomorrow that you want to have Dogecoin and everyone's going to transact in Dogecoin, which I'd buy in.
I love it.
The value will change over time, and it's going to change in value against so-called fiat currency. So that's dollars, pounds, yen, and so on. And it's also going to vary. If I could exchange Dogecoin for Bitcoin and back and forth, there's going to be variations in value there. And so tracking all of that, just because you invent a bespoke currency doesn't mean that there's going to be no gain or loss in the system. It just means the tracking of gain or loss is going to be different. And if you want to make this, and if you're ready to talk about like deep tax, we can go to all the things that these questions implicate, because Dogecoin, we have to figure out what it is to figure out what the gains and losses are, who's got to report them, where they go, and if we go cross-border, what does that mean in a GILTI world? Like what bucket does this fall into? And then sort of, does it become a driver of value or noise or whatever?
So let's dive in. So let's start in the U.S. for whether U.S. multinational, U.S. enterprise that is transacting in crypto. And then maybe we can talk about, okay, what happens when it happens overseas, and particularly an environment where that entity might be a controlled foreign corporation. We have to deal with GILTI. But let's start in the U.S. What are some of the important tax issues that our clients and taxpayers should be thinking about? And
I'll start super basic. We have to identify what this asset is to account for it. 2004, the IRS published a notice, and they said a couple of helpful things, one of which is cryptocurrencies, virtual currencies, are not currency. For 988, 987, you cannot have Bitcoin or Dogecoin as my functional currency. Pity. So we know it's not a currency, and the notice says generically it's property. And it's whatever kind of property this thing is under general U.S. federal income tax principles. And so of the things that exist today in nature, there's a variety of different types of coins, and they're all different things from a tax perspective. So you can have, for example, Bitcoin, the original base case. And for Bitcoin, for example, it's possibly a commodity. because it's subject to regulation by the CFTC.
Sure.
And that's how we kind of know. And it's traded on, for example, there are futures on the CME and sort of things where there are futures that are traded, regulated by the CFTC. We go, those are commodity. Okay,
right.
That's weird. And then moving to the other end of the spectrum, there are things that have been issued where they're really just stock or securities in virtual form. And the SEC has been very active in this space, trying to identify where you're issuing a coin in lieu of issuing corporate shares. We're going to recharacterize that as a security for securities law purposes. And then we as tax people go, well, that's really interesting. So that could be stock. And then somewhere in the middle are things that are really intended to be used as medium for payment, which we know are not going to be 988, but they're some kind of generic property right. They can be a capital asset in your hands, which corporate taxpayers wouldn't necessarily be in love with.
Right.
They could be, in some cases, like I'll take the Kodak coin, which was sort of public. They sold coins that allow photographers to be able to monetize the value of their IP in their photography. And sort of be able, if you want to order a copy of a picture I made, you could buy a coin and then use the coin to pay for it. Mm-hmm. That's basically like a little piece of intellectual property. You could do the same thing for services. Like we have lots of folks who are considering developing the capability to make in-game improvements in video games and sort of say, oh, well, I can spend a Doug coin and get really awesome looking weapons in Red Dead Redemption 2 or whatever it's going to be. So the first step for the tax department is always looking at the specific use cases and coins that folks are looking at and figuring out, what is it?
What is this asset?
And then once you know what it is, the second biggest challenge, the whole point of this exercise is to be able to let folks free exchange, to have quick settlement. For many of our clients, it's about how they face their retail customers and like the equivalent of using the coin to buy coffee. Mm-hmm. Or there was a place down the block from me in San Francisco where I could buy cupcakes with Bitcoin.
Oh, yeah?
Yeah. That's old. That was like 2010, 2011. So when I say what I've been playing around in this space for a long time, So if I have lots of transactions, every time I buy a coin, it's a purchase. And every time I spend a coin, it's a sale. So all of a sudden, things that we don't think about, if I go buy cupcakes for $1, I do not worry about whether I've got gain or loss on that dollar when I spend it. And when the merchant takes it, they don't worry about whether they've got gain or loss when they go and deposit in the bank or convert it into a bank account or something else. In this environment, every time I buy something and sell something, it's a purchase and a disposition. So I've got basis and amount realized, and I have to track that.
Of the currency itself. And you're also selling the cupcake
Absolutely.
Or whatever that. So you have basis. And so you have to compute the gain and the tax consequences of the sale of that particular widget or whatever the case may be. And then you also now the currency, if you will, that is acquiring the widget, you have a gain or loss. And then that was your point of whether is it a capital asset, is not, particularly for our big corporates, generally the capital losses are a lot harder to use than obviously an ordinary loss.
Exactly. And layer on all of our cool sort of not going completely cross-border yet, but if I'm using this as a medium for payment to settle with my foreign affiliates, have I created a beat transfer? Do I have to worry about 267 deferrals? Like all of a sudden I'm taking something which is property from a U.S. tax standpoint because I'm using it as a medium for payment. I implicate all of these additional complications that right now I just don't worry about when I transfer my functional currency. And even when I'm transferring non-functional currency, at least I've got some kinds of set of rules to help me understand the consequences.
Yeah. So when you make the payment to that affiliate, generally speaking, absent of being cost of goods sold, that's going to be a beatable payment. That's a way too big generalization. But then the point is that property, when all of a sudden that gets sold, if you end up with loss or gain on that particular type of transaction, particularly a loss, is that loss go into the beatable payment because that property you've transferred to a related party and that you've recognized a loss.
Using an analogy, like in the BEAT proposed regulations, we have a carve out for foreign currency transactions, period, full stop. And part of that was because before we had that carve out, we worried a lot about these cross-border payments in foreign currency, and a completely natural thing to do. And whether that was creating not just, if I'm paying something that's otherwise a beatable payment, but like with respect, if I transfer currency and it depreciated in value, or if I pay off a foreign currency loss, is that triggering, a beatable payment? Mm-hmm. So they helped us with respect to things that are currencies, but they didn't help us with respect to other things that I use as medium for payment. And I'm not saying that there should be an exception for cryptocurrency. boy, that'd be a big ask. But
Right.
It sort of highlights that you end up right back into a lot of the questions and the circumstances that you worry about with an asset that is relatively hard to characterize to begin with.
Sure. So let's talk then a little bit more about now when we start getting into the cross-border, you already talked about kind of the payments, but what happens as this is occurring, in a U.S. multinationals or U.S. shareholder with CFCs? How does that work in the CFC realm?
Well, and I'll take some of the really easier sort of questions, which are first, if I'm doing this in a foreign corporation who's a CFC, and by the way, it's the same questions for PFIC, because PFIC is going to look to whether something is foreign personal holding company income, for example, to determine characterization. Whether that thing is a security or sort of an asset that produces interest and dividends is relevant for me to figure out whether it's foreign personal holding company income. If it's a commodity, we have special rules for, did you improve the commodity? Did you transact in it? What did you do with it? We have different rules for intellectual property. And when is that sort of something where you're going to be able to treat it as GILTI or tested income, tested loss, depending on whether you've got gains or losses. And across all of those, I then have the sort of gating question of the when and how. Like, how do you transact in it? Are you creating it? So it's a zero basis asset to you, and on the first disposition, you have all gain because you got something of value for something that didn't have basis? Or do you have basis? Are you acquiring it from a third party? Are you acquiring it from the market? And there's a bunch of other characterizations that we might worry about a little bit, but fundamentally, those are like the gating questions. The other piece, and I mentioned the idea of some of these look a little bit like securities, there's a 1032 overlay that you just have to kind of be sensitive to, i.e. the idea that if this is a security and it's issued by someone and possibly someone in your affiliated group, I'm also tracking, is it a realization event on issuance? Because if I transact in my own stock, it wouldn't be. If I use my stock as like coin of the corporate realm to pay an otherwise deductible expense, I can take deductions there. And not to bring our M&A folks into this, but if this is some kind of security issued by an affiliate, and then I have lots of members of my global expanded group purchasing it, now I've got this diffuse stock ownership going everywhere in my structure in ways that are unexpected. So if Doug does this awesome tax planning and you sort of have a structure that's really dialed in and you know where your assets are and where your basis is, and then you come over the top and introduce what is supposed to just be like the equivalent of using currency to pay for things, but it's stock, I've now sent ownership viral across the structure.
Absolutely. And then presumably is it some type of preferred stock? What are those underlying rights? How does it determine characterization with respect to reorgs? So let's unpack some of that, because there's a lot there. The first, just to remind our listeners on the characterization point at the CFC level, right? One of the first things that we need to do as advisors, right, as taxpayers, when you're transacting at the CFC level, is to understand, is it subpart F? And then generally subpart F is going to be subject to tax at 21% in the US. And that generally is determined before you would then determine the GILTI, right? So if you've got a transaction that would be defined as foreign personal holding company, something that generates interest, dividends, rents, royalties, and you have a disposition of property that gives rise to that type of income, generally that is foreign personal holding company. It's subject to tax at 21%. And then any taxes associated with that go into the general basket. If it is not an asset that would be considered a passive asset, then, and obviously you need to think about the PFIC issues too, to the extent that it's not a CFC, but we're just assuming it's a CFC. If it's a CFC, then the GILTI, then if it's not a subpart F, then it's just going to be thrown presumably into your tested income, because you have to compute the tested income on a taxable income basis. So we then need to go back to the same principles that apply when it's happening at the US level. And then we determine, well, that's GILTI. And then are there any credits associated with that? There are a number of taxpayers that are in excess credit from a GILTI perspective. And so that's like in the US, the characterization between an ordinary asset and capital asset, whether this is a subpart F asset or whether this is a GILTI asset is really important to the analysis.
Exactly. And so you could sort of picture all the permutations where if I've got GILTI, and the initial sale creates the slug of income, but that's okay because now I've got credit coverage that feels okay, versus if I do it in a place where my second or third purchase triggers a tested loss, how do I treat that? Where does it go? Does it end up one of those subpart F losses that may get trapped in its own little category, and the crack in the sidewalk where I don't get benefit from a sub F standpoint and I don't get a tested loss for GILTI? There's a lot of different permutations here. And so a lot of times when we're talking with tax departments and their business folks are thinking about going down this path, it's a real education process, because a lot of times when folks are in the development process, they're not so drilled down on all the facts that are going to allow us to make a really good determination. So it's almost like you have to do like a Monte Carlo kind of approach where you're like, I have 5 different characterizations, and here for each of them are the tax consequences that flow from them. So the good part of that is you could be an input to the business, because you could say these 3 outcomes are bad. The risk outweighs any potential benefit. So you're going to want to craft terms. You're going to want to be regulated in a way that falls into these 2 baskets. And now that I'm in these 2 baskets that are potentially good, we're going to play out the scenarios there and sort of tell you what you can reasonably anticipate from a tax result standpoint.
Yeah. So one of the education points for me is that really getting in front of this as a tax person and tax advisor, getting in front of the business, because it sounds like as they're designing these types of transactions, there's some self-help as far as, is this a type of property that would potentially create sub F, or is this a type of property that would just go into the GILTI tested income bucket, if you will, and taxpayers can be proactive in how they are designing these fundamental transactions.
And a note on how this comes into the tax department, because a lot of times, like, this is all great kind of heady technical stuff. It may come in because someone reaches out to transfer pricing and just says, oh, we're going to have a new way of making intercompany payments, so we just want to make sure the pricing is good. Or it may come into transfer pricing because they're thinking about it as it's intellectual property. They want to make sure they're compensating for the use of the platform. Or it can come into domestic because they're trying to figure out just the basic blocking and tackling on what it is. And they may not loop in their international tax colleagues. Or sometimes it'll come in pure international because they're like, so we want to do this entity who's going to do these intercompany or third-party payments through some kind of virtual currency, crypto. So do we want to be in Switzerland or Ireland, or what's our country of jurisdiction, and what are the factors we weigh? So it can come in really dispersed ways. And I'll say I've had the honor of working with teams who work really well together. One of the great things is you got to pull everyone in.
Sure.
Because if it comes into transfer pricing and they don't talk to the international folks, the parade of horribles we just talked about. Or if it comes into international, but you're not thinking about how would I even substantiate arm's length pricing in an environment where the asset we can't figure out objectively how it's valued. Or the domestic folks are saying, wait a second, I have to have an accounting mechanism to account for these transactions, a thing that doesn't exist in nature on my general ledger, and so on. So these become really cross-disciplinary projects. And sometimes, again, the secret of getting ahead of this is making sure the business or whoever's driving it, some companies have an innovation center or something like that may be a driver, that they know that tax is a big stakeholder and needs a seat at the table for development, not just implementation.
Do you foresee the U.S. rules potentially evolving to the point where they start to characterize this more like a currency, and as opposed to a property, to avoid all of these complicated issues? Or are we just kind of on that track and we're heading down that direction?
That's a great question. I spent a lot of my day job kind of chatting with folks in government. And so there's 2 tracks where there's sort of guidance developing. There have been a couple of bills introduced from a congressional standpoint to come up with legislative solutions to some of this. There's a number of states where this is a huge portion of the market, Wyoming being one of them, interestingly enough.
That is interesting.
They got lots of space and they're relatively cold. And when I need to put servers somewhere,
Yeah, great point.
But there's states that are looking to also do this to encourage commerce. There's been a very active coalition of companies lobbying for things like either it should be a currency, it should be its own special sort of category of property that has its own taxation rules. There should be exemption for personal transactions like there is for foreign currency. So there's the taxonomy bill, which has been out there now 3 or 4 weeks, which is hoping to resolve not all these questions we talked about, but at least some of them, to kind of put this asset back into something looking a little bit more like the way we transact in currency.
Okay.
So that's one track. The other track is certainly discussions with the service. So the IRS commissioner about 3 months ago said they were going to issue guidance in a month on certain aspects of virtual currency or cryptocurrency transactions. Well, it's been 3 months. And the only thing we've gotten is the announcement that there were letters that went out to over 10,000 taxpayers reminding them that they should, report their gains and losses on cryptocurrency
That
transactions.
certainly made the tax news.
That was big doings. And it actually is kind of big doings if you were someone who received those letters. But more fundamentally, I don't know that was what the commissioner was saying was guidance. And so there's a cross-disciplinary team at the service that's looking at this and looking at some of the questions we've discussed and a number of the ones we hadn't. Because one of the biggest issues today, both and for corporate folks as well as for individual users, are that these environments aren't static. It's not like I print a dollar bill and we know what it is. This is a technology platform that's constantly improving. And because it's a technology platform that relies on the participation of folks outside your organization, in many cases, to support the running of the infrastructure, there can be something that happens called a fork. And a fork is basically, best way to put it is there are a moment of time where there's two versions of the truth. Picture my room full of people agreeing that I sold you my car. Mm-hmm. Imagine the room is split in half. And you've got half the room saying, yeah, I saw that. Doug owns Rebecca's car now. And you've got the other half of the room saying, nah, I don't think it closed. Rebecca still owns her car. So there's a fork and there's two versions of what happens. This happens every day in blockchain. And normally what happens is it gets rooted out and you come back together and you have one version of the truth again. Sometimes coins fork and they never come back together. So we had Bitcoin and Bitcoin Cash, Bitcoin and Bitcoin Gold, and so on, where they actually one asset becomes two assets. And I take you down that path not because we're going to do a deep dive on the taxation of forks and other transactions. That could be its own podcast. Commenters, if you want to hear that, we could do that. But more fundamentally, it raises these questions around, the service has to go back to old principles, like these racehorse cases of if I bought the racehorse and I knew the horse was pregnant, I can allocate my basis. If I bought the cow, but I didn't know they were pregnant and I get the calf, that's an accretion to wealth because I didn't know I paid for it. Things like that. But also it tells you what the IRS is spending their time on today. Animal husbandry, apparently. But more fundamentally, they're spending their time on these kind of base case fundamental questions. And so there's a whole host of stuff that we'd love to see addressed in guidance. But we have to be realistic about both the time that they have, the ability to answer these questions with certainty, and going back to like base case observations, because there's so many different variations on the nature of the asset itself, providing one size fits all guidance is virtually impossible.
And in fairness to both the IRS and Treasury, this is as long as we've been into a podcast where I don't think I've mentioned U.S. tax reform. And so needless to say, they've been very busy thinking about regulations and obviously U.S. tax reform in addition to this really dynamic area. Maybe the last question, and this again could be the subject of a whole separate podcast, but any trends or observations that you have outside the U.S. as far as how are foreign jurisdictions trying to tackle these issues? And again, this could be a very broad question, but just any just general trends that you're seeing outside the U.S.?
Yeah, I mean, what's great about this practice is that we have a global practice. So I spend a lot of time with my colleagues outside the U.S. And you could almost cleave the world into jurisdictions that are highly encouraging of this activity and are trying to attract it, and those jurisdictions that are taking a regulatory approach that's a little bit closer to the way the U.S. has approached it, which is not trying to shut it off completely, but being highly skeptical and being highly regulated. And that breakdown isn't necessarily what you would expect. So some of it is, for example, Switzerland has held itself out. Come to Zug. It is now referred to as Crypto Valley. Form your company here. Issue your coins. They have a whole taxation regime and regulatory regime built around this. Malta's been very accommodating. Cyprus. Singapore a little bit less so, Hong Kong a little bit less so, but we have a lot of vibrant activity in Asia Pac. And then in Europe, we've had a lot of discussions with the regulators in a number of jurisdictions around sort of what will you do with this. So it's kind of like our kind of core international planning in the sense of there's a handful of jurisdictions that are the short list of places you would think of organizing if you had someone who was going to transact heavily in this space.
And those jurisdictions are the ones, to your point, that have certainty, because that's one common theme of the cross-border tax talks. Taxpayers want certainty, and some of those jurisdictions, and it sounds like in the U.S. states as well, are trying to be more proactive to create the certainty to taxpayers to try to attract investment.
And certainly, I mean, there's been a theme here that I just want to pull all the way through, is that while we're focusing all the wonderful business and use cases that are good uses of cryptocurrency, the concerns from a regulatory perspective, both in the US and outside the US, have been because this is a decentralized ledger, because it is in some senses potentially beyond the reach of normal tracking of monetary transfers and things like that, it can be used for all sorts of untoward reasons as well. So the regulatory environment, whether folks are treating this as something they want to encourage, regulate, and get transparency to, or whether this is something they want to discourage and sort of not have within their jurisdiction, is a huge driver of policy in a number of these jurisdictions. I think the US particularly has struggled with that sort of double-edged coin of, we want to be the innovators, we want to be the hotbed of new technology, and certainly we want to reap the economic benefits, especially in a post-tax reform world. We want you to come and do business here. We don't want to send your business offshore. The flip side being, but we don't want to encourage payment systems that allow folks to skirt any money laundering and know your customer laws and sort of get in a situation where we are uncomfortable with how transfers occur. And I think that the biggest overall trend, I'd say globally, has been that the organizations that are most successful, the organizations who are making a go of this in a way that sort of has the potential to be long-term sustainable platforms, are organizations who are thinking of themselves and operating in a way that feels like a regulated environment. Mm-hmm. So even if the jurisdiction doesn't require it, even if they don't have rules that are completely on all fours, they're going into it with a regulatory mindset of, how do we be compliant? Mm-hmm. How do we interact with our regulators? And how do we do the best that we can do? And that's making some of these jurisdictions that haven't historically been all that accommodating, but we might want to be in from, say, a tax perspective or otherwise, willing to have a conversation and willing to entertain in the dialogue. And so if you're thinking about your Venn diagrams of jurisdictions that are good from a tax perspective, that makes sense in my global structure, on one hand, jurisdictions that have good regulatory environments and places where the regulators are willing to interact with us, not just tax regulators, but your comptroller of the currency equivalent, your SEC equivalent, there's an overlap there that's material in terms of folks wanting to talk to us. And I think in the vein of the type of podcast that you do, I would be remiss if I didn't mention there's certainly an overlay as well around the OECD sort of proceedings around digital, because nothing's more digital than a virtual currency.
Well, that is, I think, a perfect place to end things, Rebecca. Just a number of policy issues, technical issues. This is a fascinating area, and this has been extremely educational for me. So thank you for coming on and shedding some light on this. So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Rebecca Lee from our Washington National Tax Services Office, for shedding some light on this really interesting topic. I'm Doug McConey, PwC's U.S. International Tax Services leader. Stay tuned in 2 weeks for another exciting edition of Cross-Border Tax Talks.